In this video, we will go into some details of IFRS 18. First, IFRS 18 income statement categories. As we know, the standard classifies PL in 3 main categories and extended to 5 as follow. It's worth noting that the standard does not require labeling the income statement by the above categories. However, you can choose to do it. While labeling income statements by categories is not required, mandatory subtotal allows IFRS 18 to achieve that target. IAS 1 did not require any subtotal other than profit or loss. IFRS 18 emphasizes the requirements for specific subtotal, in addition to profit or loss as follow. Even if a company has no investing activity, and its operating profit and profit or loss before financing and income tax are equal, those amounts must still be presented separately. Although discontinued operations and income tax are presented in separate categories, IFRS 18 does not require subtotals for them. However, in practice, many companies do present subtotals for these categories, which is acceptable under IFRS 18. IFRS 18 permits the subtotal operating profit before interest, tax, depreciation, and amortization, but deliberately does not define or require that label. IASB clarified that profit or loss before financing and income tax, which may be used by companies as EBIT, should not be described as EBIT in income statement, as it could be misleading by implying all interests are excluded from that subtotal, which in many cases cannot be correct. Management-defined performance measures is key concept introduced by IFRS 18, which will be discussed later. IFRS 18 considers the operating category as the default category. To achieve that objective, the IASB decided not to define operating profit, leaving it as a boundary-determined subtotal. Usually, an entity's operations consist of main business activities. Supporting activities, these do not generate revenue. In addition to main business and supporting activities, all items not classified as investing or financing at period end must be reported in the operating category. This approach will result in volatility in operating profit due to non-recurring income or expenses. Is there anything you can do to avoid that? No. That volatility is acceptable under the standard, but you may present management's view of operating profit in management-defined performance measures. If you are a group entity, the main business activity needs to be identified at 3 levels: at the group, consolidated level, in the consolidated financial statements, at each subsidiary level, in the subsidiary's separate financial statements, at the parent level, in the parent's separate financial statements. Based on that, within the same group, the components of the operating category in a subsidiary's financial statements may differ from those in the parent's separate financial statements and may differ from those in the group consolidated financial statements. You always need to keep in mind that the standard built for corporates, not for financial institutions, while investment in certain assets or providing financing can be presented in investing and financing an income statement for a normal corporate. The matter is different when it comes to banking or investment companies, which those activities represent their core activity, which usually be presented in operating category in their activity. The standard introduces specified main business activity concept, entirely new concept to decide whether investing in specific assets or customer financing belong in operating. Do the operating, investing or financing categories in IFRS 18 follow the same concept as cash flow classification. Simply, no, operating items in the income statement, like depreciation, are classified in the operating category under IFRS 18. But purchasing operating assets is presented in the investing section of the cash flow statement. In short, you should not link profit and loss classification with cash flow classification. That was not the objective of the IASB when developing IFRS 18. An entity may present expenses by nature, by function, or use a permitted mixed approach. While IAS 1 was silent on a mixed presentation, IFRS 18 explicitly allows it. IFRS 18 does not define the term function, so management judgment is required when identifying it. It is also worth noting that IFRS 18 does not define cost of sales. Thank you.